All right, guys, welcome to tonight's class. I'm sorry for the delay. I'm having trouble with the stream on YouTube. I thought it was my broadcasters, but it's not. This seems to be a little bit better now. It looks like on my end that the quality is horrible, but that might just be me. So if you can, in the live chat, just tell me the live stream health seems great. Tell me if the quality of the picture looks fine. And if this is good, I think we should be fine because the stream health is bright green. It looks good. Great. How is the picture quality, though? Does the picture quality look good? All right, great. So let me just post this then, that we are live. And we will start class in a second. All right, guys, just give me a second here to post this, and we'll be set to go. A lot of great info I have for you guys here, and we're going to be doing some live examples. And you guys should really enjoy tonight's class. Alright, guys, we should be set to go now. Let me just get this stuff ready. All right, guys, let's see here. Quality looks great. All right, let's get a few more people in here. There's only 10 watching now, so let's give it a couple of minutes. If you guys have questions while people are joining, please ask in the live chat now, and I'd be happy to answer any questions. If you have some extra things you'd like me to cover, just let me know now, and we should be good to go. Just want to get some more people in here. funny. You get 600 people that say they want to join a class, and then, you end up having 15 people show up. But I just sent out new posts saying that the issues are fixed. I do understand it's about an hour and 15 minutes past the original time I said we'd be starting class, but we're good to go now. So any questions, guys, please live chat, comment now, make a post. Anything you guys want me to cover while we're building up the audience here? I like doing live classes because that gives me the opportunity to interact with you guys and answer any questions you guys have, because I know options can be difficult. It can be, hard to understand some of the aspects of options trading. But if you guys ask questions, I have a great way of communicating simple terms for you guys to understand much more easily. So if you have any questions, please comment in the chat room now, and we will get going in 2 minutes here. So please comment if you guys have any questions of stocks, strategies. If you guys want me to cover anything, just please comment. Matt, you asked, what are the advantages of spreads versus a regular call or put? That's a great question. All right, so basically, if you're trading just a call, for example, okay, you need the stock to move. And we're going to go over live examples of all this. But if you're trading just a call, you need the stock to be at the strike price that you picked plus the premium that you paid. So for Facebook, for example, let's just say that you're buying this week's 170 strike call and it cost you $1.50. Okay, so you're buying the 170 strike call, costs $1.50. Since there's 100 shares in a contract, you have to multiply that by 100. So it's going to cost you $150 for that single contract that gives you control over 100 shares. Now, the benefit of calls is that if you're expecting the stock to have a large move higher in that time frame from now until your expiration date, then you're not capped at a max gain. For example, if the stock goes up 5%, Facebook now, let's just say it's at 170 a share, right? So 170, let's say it goes up 3% from now until Friday's expiration. So 170 times that by 1.03, that brings shares to 175.10. Okay, so those 170 strike calls that you bought for $1.50 are now worth $5.10. So $5.10, divide that by 1.5, that's a 240% return, okay? And that's with the stock having that percent move higher, if I said 3 or 4%. But with a spread, you're maxed at that difference between the two strikes. So for example, if you did the 250 strike spread, if you bought the 170 strike call and sold the 172.50, and let's just say you got that for, let's say 75 cents, okay? Or let's say 90 cents a contract. So the max you can make, the max it could be worth is $2.50. Divide that by 0.9, you're making 177% return, okay? Now, we're going to go over live examples of this, and I'm actually going to show you guys when it's better to pick a call or put versus going with a put spread or call spread. And also what we're going to do, we're going to focus on this class, is how we find stocks that are worth trading. Some research. How do we find some research to justify the trade we want to make? And then also, I'm going to show you guys a site that I use that shows the implied expected move for a week, 2 weeks, or a month out. So for example, the one site that I use, optionslam.com, it'll tell you what the market makers, what the street is expecting that stock to do in that given period of time. So we're going to go over that. We got 19 people in here now, so let's just get started. This is going to be recording, so we should be fine. All right, now let's see. If I hit this recording button, I don't think I need to hit the recording button because it automatically records this on here. So I think that might have been what was giving me the problem before. But all right, so let's start class now, guys. We got 20 people in here, far off from the 600 that said we're going to join. But I do understand that I'm an hour and 15 minutes late. But it is going to be published and recorded for later views. All right, guys, so first things first, stock options. As you see on the screen here, there's 3 types of options that we focus on, specifically at the Santarelli Trading Exchange. All right, and really, if you're just getting started with trading options, these are the 3 types of strategies that you really just want to focus on. All right, those are calls. Let me get my mouse here. Those are calls, puts, and vertical spreads, okay? Also known as debit spreads, what I call them, all right? So a call is a strategy that makes money as the stock goes higher. Your break even is your strike price plus the premium paid. Now bear with me because we're going to go over some live examples on the E-Trade Pro platform of this. I just want you guys to have this so you could look back on the Word document and, you know, put it all together. So your break even is your strike price plus the price that you paid for that option. You have 100% return when the stock is trading at the strike price plus double what you paid for that strike. And like I said, we'll go over that in an example. Puts. A put makes money as the stock goes lower. Break even is the strike price minus the price you paid for it. 100% return is when the stock is trading at the strike price minus double what you paid for that strike, which again, we will go over. Vertical spreads. Honestly, guys, this is what I feel is the best investment strategy out there. It is by far what I consider the best investment vehicle for growing a small account into a large account. And I am going to be making another video on how to grow a small account, like a $1,500, $2,000 account into a $10,000, $20,000, $30,000 account in a short period of time, like 2, 3, 4 months. So vertical spreads. What I feel is the best investment strategy, especially for new traders, can be a call spread or a put spread. You only need a minimal move, or sometimes you don't even need a move at all in the underlying stock price and can make a large return of 100% or more. And like I said, in some instances, you could buy a spread that doesn't even have to move from where it's at now, and you could still make 100% return. You know, it ranges from 70% to 110% if you're buying a spread that doesn't have to move. Okay, but the best strategy when you think the stock will have a smaller move of less than 3% until expiration. Now, there's also a way that you could do this with buying further out of the money spreads that can give you much larger returns than calls. And that's something I'm going to go over too, because sometimes if you have a call, you know, you could still make a larger percent return if the stock has a 5 to 8% move higher than buying the call. So the vertical spread sometimes can make you a much higher return than just owning the calls. And we're going to go over this, and I'm going to make it very simple for you guys to understand. What else we're going to go over are 3 types of chart patterns that we trade. Those are breakout patterns, hook patterns, and momentum patterns. We are momentum traders. Volatility is an options trader's best friend, and that's how you make those large returns. So those are the 3 types of chart patterns that we want to focus on. Next, Three types of trade alerts we send to members at the Santarelli Exchange. Those three types of trade alerts are, one of them is breakout, hook, momentum patterns. So for that trade alert, that stock has to either show us that it's in breakout mode, it has a hook pattern formation, or that it is a momentum trade and continually going higher each day. And we'll go over that as well. Second type of trade alert that's sent. These are the weekly paycheck trades. We just implemented this new trade alert system. Members are going crazy over these weekly paycheck trades because we're buying some options that are low risk, high probability, that are making anywhere from 35% to 100% returns for a week, just a short 5 days. So I have a lot of members. We have nearly 600 members at the Santarelli Trading Exchange. And, I have some members that are traders, full-time traders. I have some that are professionals or work full-time jobs or even part-time jobs. And all they do is make these weekly paycheck trades. And they do very well with that to supplement their income. The third type of trade is spec trade. This is a speculation trade. These are usually higher risk trades. They have a chance of losing total investment, whatever you have invested into that position. And these are trades that, for example, this week we have Amazon and Google reporting Q3 earnings. So an example of a spec trade would be buying options on Google or Amazon for this week's expo since they're reporting earnings. And since no one knows what a stock's going to report for its earnings, that gives a lot of risk and speculation for that trade. But it has the chance to make a huge return. Also, with spec trades, we also do something what I coined as piggyback trades. For example, Baidu, which is a Chinese internet stock. It's basically the Google of China. It's the Google of China, Baidu. And what we'll do is, I'm sure you're familiar with Alibaba, BABA. Last quarter, or maybe 2 quarters ago, back in June, we did a piggyback trade on Baba. It's the same exact situation we're in now, same setup. Baidu was reporting its earnings. I said, guys, team, what's going to happen here is if Baidu reports a good earnings, we're likely to see Baba have a large jump higher too. And since Baidu options were quite expensive, the Baba trades were quite cheap. The implied move was smaller on Alibaba, so the options premiums were cheaper. So what we did, we bought a spread on Baba since it was so much cheaper, an out-of-the-money spread, and we only put $900. I put only $900 into this trade. And what we did then, we got it on a Monday. On Tuesday, Baba and the market in general dropped. So what we did, we bought back that short position for a gain. And then we were just long the regular calls. And then Baidu reported the stock went higher. We made a 1,200% return on that trade. It was an incredible trade. You can look at it on our performance page at the santarelliexchange.com. It was a great trade, great setup, and it's something that we can do now as well. But so far from Q3 earnings, what I'm seeing, I'm not liking. And I think this could be the catalyst for the market to start pulling back. We'll have to see how the big tech names report tomorrow. Tomorrow morning we have Twitter, Raytheon, Nokia, and Celgene, and a few others. UPS reporting, Comcast. And then after market close, we have Amazon, Google, Microsoft, Intel, Baidu, Gilead, and a few others. So tomorrow is going to be the big day, and that's the biggest earnings day of this quarter. And based on what these companies do, if we see Amazon and Google, miss earnings expectations, I think we're going to see the market start to have a pullback or start correcting, or at least have a large shift lower. Okay, so now let's go into the E-Trade Pro platform and let's go over these basics on calls, puts, and spreads. All right, so far now, is there any questions? I want to stop in between segments here, ask if you guys have any questions about what I just went over. If not, we'll go on to the next section. So please, if you have questions, let me see here. Do you guys have any questions? Now is when I'm going to go over calls, puts, and everything, the basics for those of you who've never traded or are new to options trading. So if you have any questions, please ask now. I'll give it another 40 seconds. If not, we'll move on. What else I'm going to start doing with this YouTube channel, I'm going to start posting live trades, basically over-the-shoulder trades as I make them, and you guys can see me entering a trade, exiting a trade, and whether it makes money, loses money. I'm going to be totally open, transparent, and you will see how it is to trade options live in real time. Adrian, that's a different BABA trade. There's we had quite a few BABA trades. I could actually show you guys. Actually, there's a picture on one of these YouTube videos. Big Al's an employee at TSE. I think he has a picture of the 1,200% gain that I had. If he could share it in here, I'm not sure if he could share pictures in here, but I'll share a picture of that for you. Also, we have I don't know where you guys came from. I posted in a few. Jay. I posted in a few groups today, so I'm not sure where you came from, but I have a Facebook group with over 10,000 members in it. It's called Day Trading Stock and Options Room, in parentheses, the Santarelli Exchange. So if you're not a member of that group, I highly suggest you join that group. It's a private group. It's free. A lot of great traders in there and people that want to learn how to trade options, that trade stocks, and it's a great room. All right, so let's go on to the next section now. Now we're going to go over calls, puts, and spreads. All right, guys, so first off, let me ask you guys this. Would you like me to first go over what a call, put, and spread is? Or would you like me to go over how we find a trade first and then determine what type of trade we want to make? Either call, put, spread, etc. So do you want me just explain what calls, puts, and spreads are now? Or show you how we go about finding a trade and then determining what type of strategy we want to use? All right, first I'm going to go over what a call, put, and all that is, because there's a lot of people that'll be lost if I don't do that. Okay, so let's do this. Okay, let's see here. Okay, so over on the left here, this is the option chain. We have Facebook brought up. We have the October 27th, which is this week's expo, highlighted. And in the middle here, these are the strike prices. Okay. And you have the bid, the ask, the last traded price, and then theoretical price, what you could buy it now for. And sometimes, as you'll see, there's quite a big difference between the bid and the ask. For example, this one last traded at $3.60. Here, this one up here, last traded at $7.04. But you see that you have a bid of $7.85 and an ask of $8.50. That alone, the spread is a big difference. It last traded below the bid for that strike. Theoretically, right now, it's saying you could buy it for $8.18, which is $818 a contract. This is a deep in the money spread. And if you add these together, 8.18 plus the 162.5. So basically, if you buy this 162.50 spread right now, your break even is $170.68. It's above that now because Facebook went a little bit higher after market hours, and these aren't reflected in after hour prices. But if you bought this, let's say at 3:55 p.m. and you got it for $8.18, your break even point is 170.68. So as long as Facebook's above 170.68, you're going to make money on this trade. And for you to make a double, all you need is Facebook to be at 178.86 a share, and you made 100% return. Okay? Now, guys, if you have pen and paper, I'd like you to write this stuff down, because I want you, I'm a firm believer that if you write stuff down and you see how things are, it's gonna make so much more sense to you how this works. It's very simple if you write this stuff down. So I want to go over the call side of this first. So let's do this. A call is that's a bullish move. You're betting, trading on the stock going higher. Okay, so for example, let's use the 170 strike, because this is what I would buy right now. I like this trade, and if you look at the call buyers, the total volume and the open interest on the call side versus the put side, you'll see there's many more people that are buying calls than they are of puts. So let's take a look here. All right, guys, so the 170 strike, this is what we're going to focus on right now. So let me do this. And let's see if I could do this this one way that I want to do it. Okay. Just give me a second. All right, so guys, follow along here. So here we're focusing on the 170 strike call for the October 27th, 2017 Expo. Okay. All right. So now let's do this. Now let me make it lower here. Okay, so the 170 strike call, theoretically it's saying it last traded at $1.60, but if we bought it now, it would cost $1.65. So 1.65. Okay, so break even. Okay, so that's our break even. So if we bought this call, we need Facebook at $171.65 to break even. Now for 100% return, so for us to break even, trying to see where my phone is. I see. So for us to have 100% return, we need Facebook to be at $1.65, which is what we paid for it, higher than our break-even price. So 171.65 plus 1.65. So we only need Facebook to be at 173.30. And that gives us a 100% return. Okay. Now for a 200% return, we only needed $1.65 higher than that price. So that's 174.95. And that equals a 200% gain. Or return, whatever you want to say. So as you see here, going with calls, it's very simple. All you have to do is you add the price that you paid to the strike price, and that's your break-even point. Okay? So your break-even point is 171.65. You get a 100% return if it's 165 higher than break-even. So at 173.30, you have a 100% return. And then another $1.65 higher will give us a 200% return. And for a 300% return, you need Facebook at 176.60, and you'll have I don't like how that. I want it to keep there. Let's see if I can make this a little larger. Nope. Nope. Okay, so that's how calls work, guys. Okay, it's simple, it's easy, and it's pretty plain forward. And same thing goes with if you bought the 175 strike. Let's do this example now, because I want you to get a feeling for what it is if you buy an at-the-money call and an out-of-the-money call. At-the-money call is basically the stock's trading at that strike price. So the stock's at 170.88. I mean, it was 170.60 when market closed. It went up a little bit after market hours. But now let's take a look at a different strike. let's use a red one for this. Okay. Let's do this down here. Let's make another box. Speech. Whatever. So if we buy the 170 strike call, 175 strike call, and that only costs, theoretically we could get it for between 16 and 17 cents. So it's going to be like 16 and a half cents. Let's say 17 cents. So like I said, 17 cents you have to multiply by 100 since there's 100 shares in a contract. So these prices here that you see, that's for basically one share. But you can't buy one share of an option. It comes in lots of 100. So like I said, you multiply each and every one of these premiums by 100. So in this example here that we did for the 170 strike, one contract is going to cost you $160. But you have control over 100 shares of Facebook. So it's only costing you $160 to control 100 shares, where it's going to cost you $170.88 to buy one single share. Okay, so back to this example now. Break even equals strike price plus premium paid so 175 plus 0.17 equals 175.17. So that's your break even for a 100% return. We need Facebook at 0.17 higher than break-even price. So break-even price is 175.17, and we just add another 17 cents to that, and that's 175.34 equals 100% gain. Now let's say Facebook got up to 177, for example. Okay? So Facebook at 177, let's say 177.50. So 177.50 minus our break even, $177.5, 175.17 minus, so 2.33. So that means we bought this strike for 17 cents. It's now worth $2.30. So this equals, I wish I made this box bigger here. So this equals a 1,270.59% gain. shit. So as you see, the further out of the money you go, the higher your profits are going to be if this stock has a move higher. This is just simple calls, okay? So like I said, as you see, let's see. Let's get rid of that one. Let's make it green. I mean, that's an incredible return that you guys see here. I like that. Let's do it up a little more. Heck with it. Let me just underline it. So you're making a 1,270% gain if you buy in the 175 strike call. And let's see. So how much does Facebook need to go higher? Okay. First off, let me show you guys this, because this is something important that I use. Like I said, I go to optionslam.com, and on here you could see what they're expecting as the implied move. I can't show you here, but they're saying Facebook's expected a 3.57% move up or down this week. So let's say 170.88. Multiply that by 1.0357. That means Facebook could potentially get up to 176.98. So even if it got up to 176.98, 176.98 minus the 175 strike, that's $1.98. You only paid 17 cents for it. So $1.98, divide that by 0.17, you're still making a 1,065% return. That's incredible. Where else are you going to find an investment vehicle that you could make a 1,000 or 1,200, 1,300% return with the stock only moving 3 or 4%? It's incredible. You're not going to find that anywhere else. And like I said here, for 17 cents, per share for Facebook, all you have to do is multiply that by 100, because like I said, you're controlling 100 shares of Facebook at $175 or higher. So why trade penny stocks when you could control 100 shares of Facebook for $17? That's all it costs. It's going to cost you $17 to control 100 shares. Crazy part is you control 1,000 shares of Facebook for $170. Okay? Now, for example, let's say that you put $340 into this. Okay? $340. Let's make another little thing here. Okay. Okay, so that's going to get you $340. Divide that by 17. That's going to get you 20 contracts. 20 contracts equals control over 2,000 shares. Okay, so let's say Facebook goes to, let's just say it goes to 176. Okay, those 175 strike calls are now worth 1.00, and you paid 0.17. So your $340 is now worth 20 contracts times that by 100 are now worth $2,000. So 1, divide that by 0.17. That's a 488.24% return gain. So you see, that's crazy, guys. You're buying $340 worth of these calls. And if Facebook just has a small move higher, that's what? A 3% move? 170.88 times 1.03. That's exactly a 3% move. It's worth 176.01. So a 3% move higher from now until Friday would make you a 488.24% gain. Your $340 will be worth $2,000. You can't beat that. Now let's look at the spread side now. Okay, so let's say spreads. So with the spread, we're buying a. I have to change this setting here. So let me change this. So you buy to open and sell to open. Call October 27th. Now you're going to see the difference between those prices. Let's buy the 172.50 and sell the 175. So you see here, it's going to cost 36.5 cents. So we'll round it up to 37 cents. The max it could be worth is the difference between these two strikes. So again, let's do this out now. Okay. And let's just do 10 contracts. That's what comes up normally. So now let's do this. So again, Let me not cap that. Okay, so we're buying to open the 172.50 strike call, and we're selling to open the 175 strike call. Basically, all this is, it's plain and simple. Don't overthink it. Think of it like this. You're buying the shares for 172.50, and you're selling them to someone for 175. So the max you can make is $2.50. But you're paying money to make this spread. So it's costing you 37 cents. So your max gain is the $2.50 max it could be worth minus your 37 cents. So now let's do this example. And it's not per contract for 172 and 172.50. It's 37 cents for this whole spread. Okay? So let me rephrase that so it doesn't get... So max gain equals Facebook at or above 175.00. Okay, so let's see what our gain is then. So max gain So what's that? That's our net return, okay? So let's see now. So 2.5, that's our net return, okay? So 10 contracts. Okay. So, again, I didn't put in the percent return here, so let's do that. So look at that. It only costed us $370. That's incredible. So now you see how spreads work. Now before, you've seen that we needed the stock at, what did we say, 176, and we'd make a 1,000 or 1,200%, 1,000% return. Here, we make a profit. Our break even, by the way, is, let me add another bubble here. Oops, wrong one. So our break even is simple. Okay, so our break even is that 172.87. 100% return equals 172.87 plus the premium paid. So 172.87 plus 0.37, 173.24. And we have 100% return. Yeah. A 200% return is 173.24 plus 0.37. So at 173.61, we have a 200% return. So now let's go a little bit further out, and let's do a different, let's go a little bit higher since we did that, because I want you to see the same difference between the calls and the spread with the same strikes. So now in this other example, we're going to buy the 175 and sell the 177.50. And I want you to see this. Okay, let's do this now. So we're buying the 175, selling the 177.50. Now this is going to be a huge return. So watch this. Okay. So now we're going to do the same thing. Let's do the green. And let's do the blue. And we'll do the red for the oval. Now you're going to be amazed by this gain. So we are buying We're buying to open the 175 strike call. We are selling to open the 177.50 straight call. This will cost us 0.11, which is $11 per spread contract. Okay, so 10 contracts. Let's say we're going to do the same $340 example. Okay, so 340, divide that by 11. That'll get us about 30 contracts. So 30 contracts will cost us 30 times 11. That's $330. And our max gain is the difference between the two strikes minus what we paid. So 2.50 minus 0.11 equals, what's that, $1, or yeah, $2.39, right? Yep, $2.39. So now think of this. This is what's going to be amazing for you if you've never traded options before. 30 contracts times 250 equals $7,500. So it costed us, our net gain is 2.50. So our net gain is 230. So 239 times 30, $7,170. That's incredible. And like I said, you only need the stock to go 4% higher. And like I said, all you need to make this gain is the stock above 177.50. Now, in terms of percent gain, how much is that? Let's see. That's insane. We have a 2,172.72% gain. Where else are you going to have a 2,000% gain like that? That's unheard of. Now, let me also go over our losses. So, in this example, right? Yep, $330. So, for a, what do we say, 7,500, 30 times 250, 7,500 minus 330 for a 7,170 gain. So that's the max you could lose. Is Facebook below 175 on expiration day? So that's what you're risking for possible gain. And now what we can do is look at another example of a spread that's in the money. Now what I want to do, I'm showing you spreads that are either close to at the money or out of the money. Now I want to show you a spread that's in the money, that's less risky. So these spreads that I just went over, we have to have the stock move a couple of percent to make these returns. So now let's go over an example where we don't need the stock to move whatsoever and we're still going to have a humongous return. So buying the 167, selling the 170, it cost us $1.90. Okay. I don't think that's right though. That seems expensive. 3.45 plus 1.6. So it's actually going to cost us a little lower, $1.85. But whatever, let's go with this. So let's do this example now. So, same thing. We are buying an in the money spread this time. And we're doing this for a price of $1.90. Okay, so now let's see what our max gain is. Okay, so as I said, the stock's fully in the money. This stock could drop 88 cents or it could go higher, and we're still going to make max gain on this. This will cost us max gain is the difference between the strikes minus what we paid. So 2.50 minus 1.90 equals, that's a 60 cents. So we're making so our 10 contracts do cost us, though. So what's our net return here? Let's do another one. So this is a 2.5. Divide that by 1.9. This is a 31.58% gain. And the stock can drop 88 cents or go higher, and we still make this max gain. So that's not bad. You're buying an in-the-money spread where the stock could drop 88 cents. It could also, our break even here is much higher. So our break even is 167.5 plus the $1.90. So our break even is 169.40. So only 60 cents away from max gain. But like I said, 170 seems like a key support level for Facebook, which I doubt it's going to go below. So you make this trade and you're making a 31.58% gain. That's not bad. Okay. So now that we did this, let's go over any questions that we have and see what you guys think of this. All right, guys, so let's go over any questions that you guys have, and then we're going to go on to the next subject here. So in the live chat, please, guys, feel free to ask questions. You know, this is important because spreads are my favorite. You could honestly make a living with a small account trading spreads. Like I said, you're buying in the money spreads. Where can you find an investment that the stock could drop nearly $1 and you're still going to make over a 31% return? That's insane. Think about this now. If you just have a $2,000 account and you're doing compounding profits, right? $2,000 account. If you're buying in the money spreads that are making a 32% return, right? So your $2,000 on your first trade will be worth $2,640. Then your next trade is going to be worth $3,484. Your next trade is going to be worth $4,600. Your third trade is going to be worth $6,072. Your fourth trade is going to be worth $8,015. Your what are we at? 6. Your sixth trade is going to be worth $10,579. Your seventh trade, $13,965. Your whatever trade we're up to now. Next trade, $18,434. Next one, $24,332. And, you know, just compounding. After that, $32,120. Then your 16th trade, $42,397. Your 16th trade, $55,965. Your 17th trade, $73,873. Your 17th trade, $97,513. Your 18th trade, that $2,000 is now worth $128,717. And then after that, $170,000. And then the second trade after that, $225,000. It's insane. If you're buying in the money spreads with low risk and high probabilities, and you're finding these spreads that are in the money and that are below support levels, that way if the stock drops, it has that key support level that's going to hold it above those levels, above your strikes. So your probabilities are high that you're going to make those max returns on those spreads. And like I said, this one, if you do it earlier in the week, you'll find in the money spreads like this that'll make 70-80% returns. And like I said, the stock could drop and you're still going to make those 70-80% returns. It's crazy. And that's why I've built the Santarelli Trading Exchange, and that's why we have the performance we do, because we look for the right trades, the right setups. We're patient and we're disciplined, and we make killer trades. And you guys see the profits I post on a daily basis. It's insane how large of profits you could have by using these simple trading strategies with stock options. So guys, questions. Let me see here. Let me see the questions here. Hold on a sec. Okay, good question, Party Bear. With those spreads, as long as the stock is above both strikes, you don't have to do a thing with it. You don't have to close it out. The only way you have to close the trade out if the stock is between those two strikes. If it's below the two strikes with a call spread, the spread is worthless. You don't have to do anything. If it's above both strikes, it's at max gains. You don't have to do anything. It'll expire, exercise, and get executed all on its own, and you'll be left with the profits in your trading account. The only way you have to sell that spread is if the stock is trading between those two strikes. Dave, how can those percents be right when the Greeks are... Party Bear, the Greeks do not matter with spreads. The spreads, all you need is the stock to be above those strikes. Like I said, think of it this simple. If you're buying the 167.50 strike call that you see on my screen right now, if you're buying the 167.50 strike call, you're selling the 170 strike. So that means that someone's buying the shares that you bought for 167.50. They're buying them off of you for $170. So you're making $2.50 a share. And since there's 100 shares in a contract, you do the math. 100 shares, that's $250. If you have 10 contracts, which is 1,000 shares, that's $2,500. So the Greeks do not matter with spreads. You just need the stock to be above those two strike prices for max gains. Does that make sense to you, Party Bear? Sure, ask questions. Please, guys, ask any questions you guys have. I want to make it my mission for you guys to totally, fully understand these great investment strategies that, the big fund guys and other people make it so complicated that your head is spinning. I'm trying to make them simplified, easy for you to understand, because you're really missing out on huge potential returns by not trading options. Why trade penny stocks or shares of stock when you can make these types of returns on stock options? Spreads are my way of making weekly paychecks. Like I said, that example there, the last spread we did, an in-the-money spread, that's an example of our weekly paycheck trade that we make on the Santarelli Exchange. Usually we find ones that are little higher percent returns. That one was, a 31.58% gain. We usually look for ones that are making 40 to 60 or 70% gains. But that's our weekly paycheck. Think about it. If you only have $1,000 invested in one of these spreads and they make you a 50% return, that's a $500 paycheck you're making. And you can make that on a weekly basis if you're finding these right stocks to trades with support levels that you're watching for and the implied moves that the stock's expecting to have for that week. And also you have to look at what the general market is looking like. How is the general market reacting? What's going on in the economy? What's going on in world events? Policy-wise with politicians. What's going on? Tax reform, tax cuts. You have to have all of these things combined, and you have to have a general overview of the world, the market, and make your investment decisions based on that. When you have a week like this week coming up where it's earnings season, if some of these major big companies fail to pass off or to pass Wall Street's expectations, these stocks are going to have a huge drop, and that in turn can be a catalyst for a market sell-off. So you really have to concentrate not just on that stock and that trade, but what's going on around you. What platform do I prefer? I use E-Trade Pro, as you see here. I think E-Trade Pro and TD Ameritrade are two of the best out there. Also, though, I have to say, I just downloaded the TC2000 platform, and that platform is incredible. And if you're a new trader and you open up the TD Ameritrade's Think or Swim platform, your head is going to be spinning and you're going to have smoke coming out of your ears trying to digest all that information and all the different types of tools, strategies, and things you could do on there. But TC2000 makes it very easy, very simple, and they simplify the process of everything. eTrade Pro is a great platform. It gives you everything you need. It's simple. It's the platform I've been using for about a decade, so I like that. And let me see another question here. Dave, please answer my last question. What was your last question? Oh, I would not do it as two separate orders, Party Bear. You do it as one trade. As you see here on my screen right now, there's a tab that says spreads. That makes it so it's one order. And you have to be approved for at least level 3 options to trade spreads. You know, level 3 gives you the opportunity to trade spreads, butterflies, condors, iron condors, ratio spreads, calendar spreads. You know, you have so many options with level 3. All you need is level 3, and you can do everything except for writing naked options, which you're not going to want to do unless you're an experienced professional trader. I only do it occasionally, you know, but you know, when the markets are volatile, sometimes that's the time to do it, but that's also the time you could have major losses. With writing naked options, that's the only time that you could lose more than what you have in your account. So don't even think about naked options. Level 3 with spreads, condors, butterflies, that's all you need. And that's obviously including calls, puts, and everything below that, covered calls. I'm talking about after it's opened, it shows two separate option orders on position box. Party Bear, it shows that, but when you go to close it out, for example, let's say this. So as you see on my screen here, we bought the 167.50, we sold the 170. In your trading account, it's going to show as two separate trades, but it's going to show minus the 10 contracts for the 170 and plus 10 contracts for the 167.50. Now, here's something that you can do. Now, this is a little beyond, you know, if you're new to options, you're not going to understand this much, but you know, let's say tomorrow Facebook drops 1 or 2% based on, I don't know, let's just say it drops 1% from general market conditions. Okay, what you can do then is you buy back that short leg. You buy back the 170 strike call, and you're making money on that. So you'll actually buy that back for a profit, and then all you have in your account is the long 167.50 calls. So basically, you just have a regular call in your account then. And then if the next day after that, the stock goes higher, you're not capped at that difference between the two strikes. Since you just have a regular call now, if the stock goes up 10%, you're going to make massive returns on just owning that call. So, yes, it's not going to show as one single trade because you have the option of buying back the 170 strike call or selling the 167.50 and being short, which is naked, the 170 strike. So, yes, it's going to show up as two separate orders in your account, but when you go to close it out, you always want to do it as one order. That way, you're not being charged double for commissions and things like that. Party Bear, it's simple. It tells you the gains and losses, and like I said, your max gain is when the stock's above both strikes. That's your max gain. So as long as the stock, in this example here on my screen, as long as Facebook's above 170, you have that max gain of 31.58% or whatever it was. If the stock's below 167.50 on expiration day, then you lost your total investment. If it's in between, then you're either down 1% or you're up, you know, some type of percent, but you don't have your max gains and you don't have a max loss. So that's all there is to it. Then is there any danger of max over losses if the sell side is accidentally kept? If the sell to open, if you sell to close the 167.50 and you keep open that 170 naked option, that's when you have the chance of losing a lot more than what you have in your account. But obviously, your brokerage firm is going to close that out before there's any huge losses in your account. But you'd never want to sell the call side of the spread and leave open the short leg. You don't want to do that. Keep things simple, guys. Don't overthink stuff. Too many people do that. All you're doing when you're making a spread is in your head you're thinking, okay, I need Facebook to be above 170 in this example, and I have max gain. That's all you're thinking. Don't go thinking about, oh, if it does this or that, I'm going to do this or that. And, don't overcomplicate things. You're only going to make it worse for you and worse for your account. Over trading is one of the reasons why 90% of traders fail. That over trading, being greedy, not taking losses when you should. You should always have stop orders, and you should always manage your risk, money, and portfolio. You do that, and you'll do well. And like I said, if you guys want to sign up for the Santarelli Exchange, if we get 100 new signups, we have nearly 600 members at the Santarelli Trading Exchange now. And as you see, we have unbelievable amount of reviews. We have literally over 500 reviews from members of TSE that say how much they love the service, how much money they've made, and that it's the best trading service out there. And it really is. With options, you can't pump or dump them. There's all these penny stock subscriptions out there, and all they do is pump and dump. Anyone could do that. If I wanted to make a subscription service for penny stocks, I could buy 10,000 shares of a stock that's trading at 5 cents, and then send it out to my subscribers, and they pump up the volume. The stock goes to 10 cents. Then I sell mine, and then take in my gains, and then tell my members to sell. That's pump and dump. With options, you have to be good at what you do. Because you can't pump and dump options, so you have to be good at trading. And I've proven that with TSE, that we are one of the best, if not the best, option alert service out there. And you see our performance on our page. So let's see, any other questions here? Mike, I've traded them before. If I see a big event coming up, then I'll trade the volatility, the VIX, but I don't trade that often. Yeah, when you're looking at a spread or even a call, always start off at the midpoint or even a little bit lower. Never pay asking price. If you pay asking price, that's just silly. I mean, look at this example here on my screen right now. You have anywhere between $1.67 and $2.13. That's what? Let's see, 2.13 plus 1.67. That's a 46-cent spread. That's $46 per contract. So if you're buying, let's say, 10 contracts, that's $460 difference. If you're buying 20 contracts, that's a $920 difference. So you really have to focus on your entries. Yes, we show you how we scan. Also, I'm going to go over that right now. Do you guys want to go over anything else? I'm going to show you guys now how we scan. First off, at the Santarelli Exchange, what we do on a daily basis, we look at upgrades and downgrades. Here you go on the screen right now. We use, there's a couple of different sites that we use. We look for upgrades and downgrades because, like I said again, we're momentum traders. So we want to find stocks that are recently upgraded, downgraded, that are obviously going to have a swing higher or lower based on that upgrade or downgrade and who it's coming from. If they're reputable, usually that stock could move 1, 2, 3, 4, 5%. And if you catch that right when they do the upgrade, you can make massive returns just trading the calls, puts, or spreads. So we're always looking at upgrades and downgrades. And then another site, like I said, is optionslam.com. This is the one I used to look for the implied move for the week. So here, like for example, it's saying Facebook, its current 7-day implied move is 3.57%. It's saying days to next earnings is 6 days. Next week it's coming out with earnings. So next week its implied move is 5.8%, 5.08. So at 170.88, let's say it's going higher, they're saying that Facebook could reach 179.56, which I'm sure it's going to break 180 if it reports well. So when I'm trying to find trades, this is what I do. I look for the upgrades, downgrades, see if there's any stocks there that I like to make trades on. If not, then what I do, I go trying to find stocks based on support and resistance level. If I find something I like, then I go to the option slam. I look at the implied weekly move and I calculate it. If I think the stock's going to go higher, then I'll see what the implied move is. And like I said, this is saying that they're expecting the stock to get up to possibly 179.56 if it goes higher. So what I would do then is I would make calculations on call side. I would say, okay, if I bought this strike call, what is my max gain that I could make if the stock gets to this price level? And then I look at the spread and say, okay, if I buy this spread, what's my max gain if the stock gets to this level? And then I choose which one needs the smallest percent move higher to make me the largest percent gain. And it's really simple. And then also you could go to a site like the Wall Street Journal, look at unusual options activity, and this will help you out tremendously. You go to a site like this, you look at unusual options activity. Here is the call side of the unusual option activity. They're saying PayPal, look at that call volume. EEM, it's massive. And then what you do is you're looking at this, and then look at Morgan Stanley. You're seeing some of the banks on here, United Airlines. So you're trying to see what's in this unusual option activity. Is there a whole sector that's expected to have a large move, and some of these big funds are buying into this sector? Or, what's going on? And it takes some digging, some research to find this. And like I said, it's not as simple as just looking at a stock and picking, a strike and what you want. If you really want to do this right and make a living off of this, you have to do your research and digging and do your analysis and do some technical analysis. Look at the charts and look at your implied moves and look at the news coming out for that stock. What's going on in our markets, international markets? What's going on in with the government? You have to put everything together. And that's what makes the Santarelli Trading Exchange so great and why we have so many members. We do all this hard work for our members, and we share it with you, and we share our trades. You'll get an email and text alert of the trades we make, our stop orders, our target prices, and then you'll get an email and text alert when we sell. And, also the same thing with classes. We have a live trading room too. And the live trading room, we're constantly posting stock charts in there all day, every day, of potential trades that we're seeing that we like their setups. And so, and then also there's a lot of members inside of that chat room. They're sharing their trades, their ideas, and their charts, and it's a great community. It's a great team that we have at Santarelli Trading Exchange. I honestly have the best team that I could have ever asked for. So, is there any other questions? There any other questions? Anything else you guys want me to go over? Trying to think here. Okay, let me show you guys this though too. I want to end it with this. So based on what I just showed you, why would you want to trade penny stocks or shares of stock when you can trade stock options for the price of penny stocks and have larger returns than any other investment vehicle out there? You can control shares of Amazon, Google, Facebook, Tesla, Priceline for less than $5 a share. And like the examples I just went over with you, with the calls, with the spreads, you could easily make 100% or higher returns, and you're not going to find that with penny stocks. You're not going to find penny stocks that have low risk, low volatility. Whereas with these stock options, you could easily find shares of stock that are trading you could find positions that are below support levels that could still make you 30 to 60% returns, and as long as it doesn't go below those support levels, you're locking in those large gains on these big blue chip stocks, tech stocks that are almost $1,000 a share or more. And like I said, then with weekly paycheck trades, you're doing in the money spreads. That's what we do at Santarelli Exchange. And you really you can't beat it. Stock options is where the real money's at. That's in my opinion. Let me see what else I got here. Okay, guys. For the viewers tonight, for anyone watching, if you'd like to try out our service, like I said, we have a team of nearly 600 members at the Santarelli Trading Exchange. And we send you trade alerts via email, via text, and we have a live trade room. We also post trades in there. We share ideas in the trade room. We share chart setups, news, analysis, technical analysis. We share anything and everything in there. We have a lot of people in our trade room, and we're like family. It's a great time in there. Everyone's learning, and we're making money on our trades. So if you'd like to join us, I'm giving $1,000 off for the year if you use promo code YearTrader. All capital letters, use promo code YearTrader for $1,000 off. So it will only cost you $1,400 for a 12-month subscription. Or if you want, you could use promo code HALF-OFF, and that's for 50% off, which is $100 off your first month, and then it'll go to normal subscription price of $200 after the first month. There's no contract. You could cancel at any time with the monthly subscription. Just make sure you cancel before you're charged. And if there's any other questions, you could feel free to email me at davesantarellijr@gmail.com. You could click the Contact Us button on our website, which you guys should all go to our website now and sign up for our free newsletter. When you click on our website link, it'll take you here. This is the pop-up. You put in your email address, and we send out weekly newsletters of whatever is going on, and we do a recap of how our week is and was, and anything else that we see that might be happening in the markets, or maybe some setups that we like and we might be trading. And like I said, if you'd like to sign up, all you have to do is go to join now or register and sign up. You could use your promo codes. You could go to our performance page and check out our performance. Also, market news. You guys could go to market news. You don't have to be a member for this, and you can see we have a new trade alert system. You could click on this link and view that. And there's so many things that you could do on our site. And like I said, we have one of the best option alert sites out there on the web. So you could sign up at the SantarelliExchange.com, and we'd look forward to having you. Any other questions, guys? I think I covered everything. The trade room is right here. Let's see. There's probably no one in it right now since its market's closed, but here is the trade room. This is what it looks like. There's 13 people in there now still, but this is the trade room. This is what it's like. We're talking all day long about charts. Here's some chart setups that we go over. You see, we're sharing everything we possibly can with you guys, whether it's sectors that are breaking out that we like, whatever it is, we are sharing it with you guys. You know, there's Priceline chart, there's Wells Fargo's chart. You know, we're showing you what the what each sector is doing here. You know, and like I said, when it comes to education and learning, if you guys want to ask questions in the trade room, if you join, we're more than happy to help you and teach you, educate you. If it's something short, I'd be glad to do some one-on-one with you. Just sign up for service, and we will see you in the trade room. Any other questions, guys? Yes, of course, Adrian. If you have a question or if you have an idea on a trade, you can post it in the trade room, and I'll give you my comment on it. I can't tell you to buy it or what, but I'd be happy. Just don't bombard us, with 20 stocks, just a couple here and there. Because I'll have people that'll message me 50 stocks in a day. My job's not to analyze all the stocks on the exchange. We have to find some stocks for us to trade. So if you have questions, like I said, I'm happy to help. If you need help learning, I'd be more than happy to help you. And if you have any questions, like I said, just shoot me an email, contact us on the website, make a comment on this video below. You could contact Big Al, ask him questions. You could go to our business page, ask a question there. My Facebook, you could go there, whatever you'd like. All right, guys, any other questions? Thank you, Adrian. You appreciate everything I'm doing. I'm trying my best to help educate people about stock options. It's underrated. Not many people know about it. And like I said, it's the best trading and vehicle out there. It's the best investment vehicle out there, especially to grow small accounts into large accounts. When you can make 35% gains on a continual weekly basis, you're going to grow that account large quick. And if you have the right trading plan set up, and you have the discipline, the patience, and risk management control, portfolio, money management control, you're going to do well, and you could grow that money very quickly. So any other questions, just message me. It was a pleasure having you with us tonight, and God bless, take care, and we'll see you tomorrow. And we'll have more videos to come. And if you're a member of TSE, you get a whole onslaught of deeper education material, and we really help you more one-on-one if you're a TSE member. So feel free to join, and have a great night, guys. Take care, God bless, and good evening, good night. Thanks, guys. Thank you. Thanks, Umar. Thanks, Matt. Thank you, Charlie. Good night, Al. Thank you, Blue Sequoia. Thank you, Shaquille. Party Bear, thanks. Have a great night, guys. This is a pleasure. I love doing things like this. I love educating. Whatever I could do to make things simple. Good night, guys. God bless.